Welcome to Region 3 PTAX webinar. We're very excited about the topics that we have for the two webinars that's scheduled in October. Tonight will be focused on reading financials. Throughout the webinar, we encourage you to type your questions in the chat box that you see on your screen to the right. Throughout the presentation, our speaker will pause during the presentation to address questions as they come in, and then we'll also designate a few minutes toward the end of the presentation or at the end of the presentation as time allows to address questions. Our bi-monthly, a couple of announcements I want to make before we begin. Our bi-monthly director call will be on November 3rd, and we will be presenting information from the National Center for Systemic Improvement. They will present what they're working on and their progress so far. As you all know, they provide states with technical assistance to support their school systems, local early intervention service programs to improve educational results. Our next webinar that you got information through the listserv will be October 28th at 1:30 Eastern Time. Please save the date. Bill Kreisner will be speaking about the changes recently in the law related to exemption and non-exempt status. For this webinar, following the presentation, we'll email out the handouts to those that attended the webinar. And we're very lucky to have Glenda Hicks back, who was one of our presenters in New Orleans recently at our annual conference. So you've got to know her through a number of different presentations, including that conference. She has over 28 years of experience in accounting and business and has served the financial and management and board governance needs of nonprofits for over 14 years through training and consulting. She's served on several nonprofit boards and is continuing faculty member for certification courses at the Georgia Center for Nonprofit and a former adjunct professor at Brenau University and the University of Miami. She recently became a BoardSource Certified Governance Trainer. And so, Glenda, it's your time. Thank you.
Great. Thank you very much, David. Good evening, everyone. It's my privilege and honor to be here with you this evening to lead you in a orientation and training on the world of nonprofit finances, and in particular, analyzing your organization's fiscal health. We have a number of folks on the call, and since I don't know anyone personally, I have to make the assumption that we have a wide variety of knowledge on the call. So some of you may be novices, very new to nonprofit financials, and not have a strong background and understanding, all the way up to those of you who are very well versed. But what we were hoping to accomplish in having this webinar is to really lay a foundation of understanding. So we're not going to dive deeply into finances and accounting and understanding statements because there really is a wealth of information out there. There's so much that I could have put into this presentation. You literally could spend an entire day going over all different aspects of fiscal health, but that's not our intention and our goal. Our goal is to give you that understanding of some key things and to help the board members in particular, and then staff who might be new to nonprofit accounting, but not necessarily accounting in general, but nonprofit accounting, what some of the differences and nuances are. So with this slideshow that we have for you, it's basically divided into 4 sections. The first section is going to talk about just the board's overall basic responsibilities, their financial responsibilities as a board member. Then we'll move into talking about key financial terms and definitions that you'll encounter as you serve on the board and begin to look at various reports and information from staff. Then we'll talk about the audit and what it is intended to do and what the reports are that you get from an audit and how you can use that information. And then we'll actually conclude with looking at a set of financial statements and an audit report so that you can just look at a few things that you can zero in on to get a better understanding. So hopefully this will give you a good foundation. At the same time, it might reinforce some things that you thought you knew but you weren't maybe sure about, and then maybe teach you a few new things along the way as well. So as David indicated, if you'll just type in your chat questions as we go, then I'll pause as we go from one section to the next and take a look to see what questions we might have that I can answer at that point, and then we'll again save some time toward the end. So this is the board's financial basics section, which really I like to call the board's basic responsibilities. And I'm not going to read directly from the slides because obviously you can read them for yourselves, and that makes for a very boring presentation on top of finances, which are typically not the highlight of anyone's day. So what I'd rather do is kind of discuss the general topic and expand a little bit on each slide and maybe give you some best practices or hot topic areas with respect to each slide. So on this first one, we're just talking about the basic responsibility of a board member and their legal duty. So many times folks come onto the board, and if they don't have financial knowledge, they will pretty much abdicate that responsibility to the finance committee and just take comfort in the fact that, you know, the finance committee will handle it. They know what they're doing. But the reality is the board members, each board member has a fiduciary responsibility and a legal responsibility to understand what's going on with the organization's finances and to help plan for how the organization will sustain itself. And that comes throughout the year as part of your board meetings, but also the strategic plan in terms of how have you outlined in that plan what the organization is going to accomplish and how they're going to accomplish that with the resources that it has, and then how is it going to obtain the resources that it's lacking. And the largest resource we tend to think of is financial resources, although of course it at the very foundation you're talking about money. So there's three primary duties that a board member has, and that's duty of care, duty of loyalty, and duty of obedience. So you have an obligation to make prudent decisions, to look at the facts and circumstances as they've been presented by expected to rely on, those people being your finance director, your bookkeeper, your auditor, your treasurer, your executive director. So you have a duty to exercise due care in looking at that information, reading it, and asking the appropriate questions. And of course, the duty of loyalty is to that agency, but also to ensure that that agency survives your tenure on the board. So you're making your decisions with the expectation that you're going to leave the agency in a better place than you found it, and in a way that it can continue to sustain itself. So really being able to understand the financial reports you receive is critical. And then the duty of obedience speaks to you following the rules, being in compliance with laws and regulations that affect your organization. So you are accountable to various entities and regulators, the IRS, and funders that provide you resources and such. So all of that comes back to the financial health of the organization. And for this reason, most organizations understand that they need to carry D&O insurance, directors and officers insurance, to cover the cost incurred should they ever have to defend themselves with respect to decisions they've made around the board table. So again, understanding some basics, we'll look at different positions within the organization, again helping board members to understand who all is involved in the financial process. And the highest level of responsibility would, from a staff perspective, is the Chief Financial Officer. And not all organizations have this position. It really depends on your organization's size in terms of your budget and in terms of the number of employees you have. And a lot of times terms are used interchangeably, and we'll see that on the next slide as well. Some people call their top financial person the finance director, and some the controller and the CFO. But this is my opportunity to provide you textbook definitions, if you will, of some of these positions so that you have a better understanding of who is ultimately responsible for what tasks. So the Chief Financial Officer is really that top person who's managing the financial and accounting operations of the organization at a higher level. They're taking all the information that's been produced in the accounting department and generating in most cases, the reports that get presented to the board, to the executive director. And they're managing those relationships, the relationships with the bank, with any lenders that you might have obligations with regulators. They're that primary point of contact within an organization, and understanding that many of the organizations are as small as 2 people or 3 people. You may not have the luxury of having a CFO and then all the respective positions below it, and you might call your sole person a CFO, but technically if they're not carrying that senior management level responsibility along with the bookkeeping that they're doing, then they're really not the CFO of the agency. The next level of positions would be this category of the finance director, controller, accountant, bookkeeper, working your way down if you visualize the very top, and then working down into getting closer to the line staff. And again, these are the folks that are literally keeping track of all the transactions that your organization is originating, entering into, every purchase you make, every disbursement, every payroll that's processed. All of that information is maintained in the accounting department by the clerk, the bookkeeper, whomever you have in that role, and then rolling up successively to higher levels to pull that information together and make sense of it, and to begin to provide more summarized information to the board or to the director if you have enough layers of positions, and then even and working with the auditor when they come in and providing any information they need to prepare the tax returns and so forth. The treasurer, all boards have a treasurer, one of the required positions, officer positions, and this is the person that is ultimately responsible from a legal standpoint for the financial operations of the organization. And oftentimes in small nonprofit agencies, this person literally has rolled up their sleeves, and they may in fact prepare the 990, the tax return. At a minimum, they're working intimately with the accounting department, whomever that may consist of, in conjunction with the executive director, and working with the finance committee and preparing, maybe preparing the budget in concert with the executive director. But at least they're the ones who holds that ultimate responsibility. Oftentimes they're the one who signs the 990 for the organization. Now, I have seen organizations where the executive director will sign it, or even the chair of the board, but preferably, this being the treasurer's responsibility, they would be the one that's signing that return. But as I've described, it really depends on the size of your organization as to how much this position is involved. Excuse me for 1 second. Throat was getting a little dry. It really depends on your size of your operations from a budgetary standpoint and a staffing as to how much they are involved. When we turn to the more to the board and its role and responsibility. Ideally, you would have both a finance committee and an audit committee. What we tend to find in practice, however, is this committee is combined. And a lot of times that's because there's just not enough folks around the table to create two separate committees. But from a best practices standpoint, you need for these two positions, these two committees to be separated. And the reason is the Finance Committee is the one who's actually involved in the creation of the financial information. They're helping to prepare, in a lot of cases, the budget alongside with the executive director or the finance staff if the staff of the agency doesn't allow for that process to be done entirely by the compensated staff. They're working with investment decisions, financing decisions, and this is assuming you don't have a separate investment committee. They're meeting on the financial information on a periodic basis. And a lot of times, again, depending on the state that your organization is in, it may be that your board does not receive complete financial information every month if you meet monthly. The Finance Committee may be in a position where they're looking at that detail and they're presenting summarized reports to the board. And this works if your organization is very financially stable, that they have sufficient funds in their bank accounts, the cash flow is solid, and there's no critical issues around the organization in terms of meeting its obligations, its debt obligations, it's paying its bills, so to speak. And there's no issues around perhaps merging with another organization. There's nothing big on the table that the organization needs to be concerned or worried or address. So they're able to allow the Finance Committee to have those detailed meetings and then provide summarized information to the board. The Audit Committee, on the other hand, is for the purpose of overseeing the audit process. And if you look at it this way, the Finance Committee is doing the detailed work. The Audit Committee is coming in to check behind them and ensure that it's proper, it's appropriate, it's free of errors, that there's no defalcations of any kind. And so if you have the same people forming each committee, then there's no independence. And a lot of organizations don't understand that that's the critical reason that you would have a finance committee separate from an audit committee. The audit committee, however, does not have to exist for the entire year. Some organizations, because of that staffing concern with not having enough folks on the board to populate every committee, will make the audit committee an ad hoc committee instead of a standing committee. Instead of being year-round, they convene when it's time for the audit to occur. And what they will do is retain the audit firm if it's that time where you need to go out for bids and select a new firm, or at least review the adequacy of the firm that you've been using for the past several years. Then your audit committee would be charged with that process. As the auditors have questions throughout the audit, they would come back to the audit committee to present those questions. And when the audit is concluded, they would present their report, at least initially, to the audit committee. And then from there, they would present a more summarized version of their report and findings to the full board. So in terms of best practices, this is something that you would want to move toward as a board if you're not able to have two separate committees at this time. And this helps you to understand better how to explain to the rest of the board why this is necessary. The auditor, of course, is, the independent outside firm that's going to come in and review your financial operations and render an opinion on that. And we'll talk more about the auditor when we get to that section of the presentation this evening. So again, looking at these basic foundational responsibilities, what are the documents that the board should review? At a minimum, they should see the audit report. Even if you have an audit committee and the committee has been presented with the findings of the audit report by the CPA, the report itself still needs to go before the full board. And this is their opportunity at least once a year to see everything before them and to run various comparisons and analyses and calculations to see how the agency is tracking from one year to the next. But in the interim, a monthly or quarterly report is provided by the finance department, the accounting department, to the board, and that's your internal financial statements. And ideally, you're presenting the finance committee and or the board with a balance sheet, a profit and loss statement, a budget versus actual comparison, maybe a cash projection or a cash flow, any number of reports depending on what your board says they would like to see and what's necessary. So you can have any number of ad hoc reports that are presented. But in the question of the annual audit, I've often been asked, should we have an audit? And audits are so expensive. And the answer is yes, they are very expensive. And some organizations have opted to get a review, which is less in scope. So the auditors they don't pull as many documents to look at, and therefore it tends to keep your costs down. And a lot of funding organizations will accept a review, but it's really a question of two things. One, an audit gives your agency credibility in the community and says that at a minimum you have controls and systems and processes in place to allow you to produce accurate, timely financial information. And at the same time, it gives you an opportunity to seek funding from other places that require an audit. And if you didn't have the audit, then you would be precluded from applying for that funding. But I was just speaking actually yesterday with an agency, and she's the founder and the director of the agency, and she was sharing how she tried to save money and get a review, but in the end, for them, it wasn't productive. It did not allow them to get what they needed in terms of going after certain funding. And she literally felt like she had wasted her money, and so now they're in the midst of having an audit for the first time. And so fortunately, she's in a position with her agency to pay for that. So that's just something that you have to explore at the board level and determine, why are we having the audit? Best practices suggest that you get one, but again, it can be expensive. And a lot of that is not even because of your size, it's because of things that auditors have to do at a minimum before they even contemplate the size of your organization in order to be able to give you a competitive bid. So just some additional insight there as you look and have those conversations. Should we do an audit? Should we do a review? So when we talk about the financial statements themselves, this is what you're going to receive in the packet. You'll get the auditor's report, which is the letter that you're after. That's the opinion. And you want that opinion to be unqualified. And I have a slide going forward where we'll talk about the different types of opinions a little bit further. But you'll also get the financial statement of financial position, which is your balance sheet. This is going to reflect everything the organization owns, everything they owe, and then what remains after. What's the difference? The statement of activities is what we commonly refer to as the profit and loss statement, and that is another report that's standard along with the changes in your net assets. Functional expenses is the report that's going to show you not just how you spent the money in terms of salaries, rent, and such, but it will show it by function. Was it for programs? Was it for management in general? Was it for fundraising? And this is how it's presented on the 990. Statement of cash flows is a report that is really banker's report, if you will. They use that a lot in different decisions that they make, but it's going to show you how the cash actually moved through the organization, which is not necessarily what's going to show up on your statement of activities, because that depends on if you're accrual basis or cash basis. And we'll talk about a lot of these terms I'm throwing out when we get to the terminology section. But at this juncture, I just want to make sure everyone is familiar with the basic statements that they would receive in an audit report. The next are the notes to the financial statements, which is all the narrative that appears at the end of the audit and provides a lot more detail and information. And then there's the supplementary information, and this can be any number of things. It will vary. A lot of times funders, especially federal government agencies, because of who they are, they require certain additional reports within the audit report. And so there's a number of supplemental reports that might be included. But these collectively comprise that package that you're paying for from the auditors. I guess another thing to point out here too for the board's understanding is that even though you're getting this package, the only thing that the auditor owns, if you will, is that first bullet point, their audit report, the 2-page opinion letter, or 1 page depending on how much needs to be conveyed. Everything else is the agency's statements. So these are your financial statements. This is your balance sheet, your statement of activities, your statement of functional expenses. And oftentimes I hear organizations saying, referring to them as if they're the auditor's statements. The auditor has to put the statement together, or the auditor's entries are not ready. And we kind of lose sight that these are our statements as the agency, as the client, and all the auditor is doing is making a statement, giving an opinion on whether our statements are properly presented. And the reason that's important, and the reason I point that out, is because it's becoming more and more prevalent that auditors are requiring the client to do more of the work. They're requiring you to have more of an understanding and a knowledge of what to do with your numbers. Because just as I described the difference between the Finance Committee and the Audit Committee, where the Finance Committee is doing the work, the Audit Committee is checking behind them, the independent CPA cannot audit their own work. So if they're putting your statements together and they're doing all the entries, they cannot also audit what they just did. So you might be running into situations where, as an organization, you're trying to call your CPA and ask them a lot of questions, and they're giving you limited assistance. And that's because the more they tell you how to keep your books and how to account for a transaction, the less independent they're making themselves, which means they cannot come back in and audit your books because they helped create the books. And so a lot more auditors are becoming diligent in enforcing that, if you will. It's always been the case, but as a courtesy, they've put your statements together for you as a practical courtesy, but they were really your statements. But because they were doing that, it started leading to this perception that, you know, the auditor's statements are not ready yet, or what have you. So I just want you to put that in perspective and understand that it's becoming more incumbent upon you to have the expertise necessary to understand how to maintain your books and records, and with, you know, what accounting rules you need to be in compliance with. And you accomplish that through the staff that you have by ensuring that they have the proper training and education, but also at your board level, making sure your treasurer is sufficiently competent in nonprofit accounting and rules, that every member around the board table has some working comprehension. They don't each have to be held personally responsible for having an in-depth knowledge, but you have to have access to that resource. And then the other opportunity, which I see, is where nonprofit agencies will contract with an outside consultant, accounting consultant or CPA that has expertise in nonprofit accounting, and they will use that person as their resource when they have questions and not their auditor, so that the auditor can do what they need to do in terms of auditing your financials and rendering their opinion, and then you can get questions answered on everyday matters from a totally different consultant. The other item which we addressed in a prior slide when we were itemizing the things that the board should look at on a periodic basis were the unaudited financial statements. And this is what's being produced for each of your meetings as a board, but also internally. Even if the board meets every other month or every quarter, on a monthly basis, the accounting department is still preparing the information and the reports, even if it's not presented to the board, because someone is still looking at it. The controller or the finance director or the executive director is using that information. And it could be, at a minimum, as I said before, cash flow projections, profit and loss, maybe bank balances if you're not doing a full statement, investment information in terms of having an understanding of how your returns are coming in on your investments. Is it consistent with the policy that the investment committee set? So your interim information can take any number of forms. And this is where we talk about dashboard reporting as well, because maybe you have certain things that are summarized and just presented in one sheet to give the highlights, and then you still have the in-depth detail behind it and all the financial reports and statements, but perhaps just the dashboard, the summarized document that's highlighting key pieces of information that the board has an interest in is provided to them from one month to the next. Other financial reports, the last category, your 990, which I've referenced, is another required report, and this speaks back to duty of obedience, where you maintain that you're in compliance with all laws and regulations. So just making sure that if you have revenues that exceed $50,000, then you're required to submit a 990. If it's less than that, you don't have to file the report, but you still have to complete what's called a 990E. A 990N, an e-card, electronic return, where the IRS is just asking for basic information, name of the organization, address, officers, and then a confirmation from you as the organization that you did not have over $50,000 in revenues. But just ensuring that that's prepared and presented to the board. An annual budget. I've worked with organizations that have been in operation for many years, and they didn't have a budget. And so helping them to create a budget for the first time was crucial. And this is a key component to the financial operations of an organization, so that the board has a way of measuring the performance of the agency and knowing that this is the strategic plan that we set. This is the financial plan we put in place to help us to get to where we need to go in terms of the goals and objectives we have established. And then the one of the monitoring tools is to compare the budget to actual and see how we're tracking. So creating a budget is critical. And creating a budget that gets approved before the new year is a best practice. You know, some of the things I say may sound obvious or intuitive, or you might laugh and think, well, who of course. But in practice, it's not always the case. And sometimes you don't get a budget approved before the new year starts. And maybe you have a policy that says we will operate with the previous year's budget until the current year's budget is approved in January at the first board meeting or something to that effect. So I have seen situations where the new year has come in and the budget hasn't been completed yet. And then again, as I said when I was talking about the dashboard, there just may be other key areas that the director or individual board members have an interest around and want to know how the agency is tracking in that area. And if you're an agency that's actually taken out a loan, which is maybe foreign to some of you, you don't perhaps think of nonprofits as taking out loans or having lines of credit when in fact they do. And there's other nonprofit agencies out there whose purpose it is to fund nonprofit organizations in this way. I may mess the name up here, but some of them are community development, financial institutions, or something along that line. It's escaping me at the moment, but that's their purpose, is to help the financial needs of nonprofits by providing them bridge funding. A lot of times if you enter into federal or even state or local contracts, government contracts, there's some delay in the execution of the contract, or there's a delay in the reimbursement under that contract, with you perhaps providing services in January, submitting an invoice in February, and then receiving payment in March. So that's a long time before you get funding, and so you would need bridge funding to carry you through, or if you have a seasonality around the services that you provide, you may need bridge funding. And some government institutions will give you an advance on your grant, and some will not. And so that's where funding in terms of lines of credit or loans comes into play, and questions around, have you made the timely payment? Do we have the funds in the cash flow to meet the upcoming payments? Becomes an important factor that boards want to stay aware of. And then two, if you actually have a loan, then there may be covenants that the loan carries with it. And so the bank is interested in your financial information. Again, going back to that compliance responsibility of boards. And then, of course, investment statements. Now, the board, they may not actually receive the physical investment statement, just like they would not necessarily receive the bank statement. But the treasurer perhaps would be in receipt of these documents in addition to the staff person who has that responsibility. Okay, so now we're moving into section 2. So before we start section 2, I just want to jump back for 1 second and make another observation, and then check in with the chat box to see if we have any questions at this juncture. But one of the things I recently learned about as being another best practice that I've now started sharing with everyone when I do these trainings is when you have new folks that come onto the board as board members, something you might consider doing is having them, requiring them rather, to serve on the finance committee for a period of time. And the first reaction is, oh my gosh, you know, most everyone's going to say no, they don't want to do that because they don't understand finances. That's not why they got on the board. But the irony to all of that is that's a great way for them to learn about the finances. You do not have to have a finance committee that's comprised entirely of financially savvy individuals. You certainly want the chair of the committee to have that knowledge. The treasurer ideally would have that knowledge, although I do see that where the treasurer doesn't have the knowledge, but they were willing to take the position, so they are in that position. But after you have at least 1 to 2 folks on the committee who are trained and educated in that area, then you can fill the balance of the committee with individuals who are not. And that's a great way for them to see the numbers of the organization and learn how to read them, how to understand them, because again, they do carry with them all the other characteristics and skill sets of being able to make management decisions and being able to evaluate different options and understanding the programs of the organization and such. So with those other skills, as they learn about the finances, then they can contribute to the committee at a greater level, and then eventually they'll roll off and someone else will roll on, and then everyone on the board at some point has had an opportunity to serve on that committee and become better educated about the finances. So you might write that one down as a tip. So as I begin to look here at the chat box, I do not believe, let me see, if you'll just indulge me for a moment as I go through and see if I have any questions that any of you have presented. Okay. No questions. All right. Then we will move on. Common financial management definitions. So I'm not going to read the definitions again, but what I will reference you to is the first handout. And forgive me, I'm not sure whether or not you have this in your hands at this point, but certainly after the presentation you'll get all of these documents if you don't have them in advance. But one of the handouts I have for you is Understanding Nonprofit Financial Statements, Key Terminology. And so it certainly is not all-inclusive, but it does contain a number of key terms that are used as you discuss the financial health of your organization around the board table. And so this will be hopefully a great resource for you to begin to know the terminology that is used. So you can certainly have that as a reference. What I have on these slides are just a few of those terms extracted just to highlight for you verbally some of the key terms and then entertain any questions that you might have. Generally accepted accounting principles, those are just the rules, the accounting rules that are to be followed. And they're to be followed if you're on an accrual basis. And I do believe that the majority of the organizations that are on the call are on an accrual basis, but just for explanatory purposes, if you're on a cash basis, then this does not apply. Generally accepted accounting principles only apply if you're on an accrual basis. And when you receive an audit, the audit opinion is stating whether your financial statements fairly present the fiscal health of your organization in compliance with generally accepted accounting principles. So by default, if you're having an audit, then your books are on an accrual basis. If you maintain your books and records on a cash basis during the year, and many organizations do, because it makes more sense to them, it's more intuitive, it's like your own personal checkbook at home, where if you receive money or you pay out money, then that is what goes on your tax return. If you didn't collect it, if you didn't pay it, then you don't account for it. So that makes logical sense, and a lot of boards like to see financial information on a cash basis because it makes sense to them, and it's easier to make decisions about upcoming activity if you can say, yes, we have this in the bank and we're expecting X, Y, and Z in the next 3 months, as opposed to looking at what you've earned and not yet collected. And that's the difference between cash basis and an accrual basis. Is accrual, you're going to account for things that you've earned even if the grantor hasn't paid you, or obligations that you've incurred, for example, purchasing something on a credit card, even if you haven't paid for it yet. So that's the critical concept behind generally accepted accounting principles. And the next one is just the FASB, the Financial Accounting Standards Board. That's the group that hands down these rules. So as simple as that. That's where the rules come from. Accrual basis, this is what I was just getting into, so you can read this and see in more detail what I've just described. But if you're on a cash basis, then an audit would not occur, but you can convert your statements from cash to accrual. And that's usually where the auditors have historically assisted clients, is in providing those journal entries that adjust their books and records from the cash basis they've been maintaining throughout the year to the accrual basis that they need to be on in order to have the opinion letter rendered. And so again, to the degree that you can gain that understanding of how to create those entries, what entries are necessary, the better off you'll be in terms of seeking another consultant or bringing that expertise in-house as a staff person. Fund accounting, a basic foundation to nonprofit accounting, which says that you have to account for every source of revenue. Funds from Foundation A are to be accounted for separately from funds that were provided by Foundation B to the extent that they're requiring you to do specific things. Not much else there, it's just the concept of keeping everyone's money separate. Now, typically the question arises where they ask, well, does that mean keeping everyone's money in a separate bank account too? And the answer is, in practice, most funds are not kept in separate bank accounts, because if you have 20 different sources of funding, you'd have 20 different bank accounts. However, I have seen organizations where they literally do open separate bank accounts. But the key is that your record system allows you to track those funds separately, unless there's a requirement that you physically put it in a separate bank account. And in some cases there are, especially if you have loan requirements that say a certain amount of cash needs to be kept available, then you might put that in a restricted, funds bank account. But for the most part, as long as your accounting records will allow you that opportunity to track the funds separately, so that you can give reports to those funders, and so that you can report in both your financials and your 990 how much of the funding is restricted, unrestricted, for programs, for management in general, then that's the purpose, that's the overall goal. Accounts receivable, to describe it simply, it's what's owed to you. If you have rendered a service and you have yet to be paid for it, that's going to show up on your balance sheet as a receivable. Now, it's showing here as accounts receivable. It could very well have said grants receivable. Maybe you're still waiting to receive funding from a federal agency and you've already provided the service. It could have said pledge receivable. Maybe an individual donor has said, we pledge to give your organization $1,000 6 months from now. The fact that they've made the commitment makes it a receivable. And so as you look at your financial statements, you'll see these dollar amounts in the receivable section. Payables, the opposite. Any funds that the organization owes and has not yet paid. So if you're making purchases on account, that's the account that this information is going to be reflected in as you look at your financial statements. Prepaid expenses, this is an account that's going to capture those dollars that you've paid out, but you have not incurred the expense yet. So usually you'll see this in things where you might have an event later in the year and you need to pay for the venue up front, or at least put a deposit down, and then when the event occurs, you'll realize that expense. Property, plant, and equipment. These are those assets, those items that the organization owns that's going to give them benefit into the future. So these are just your furniture, your fixtures, your computers, your buildings. And each organization should have a capitalization policy. You should have a policy that's been established that defines at what dollar level you're going to record something as a permanent asset of the organization. A fixed asset is another term for it. And typically, it's $500, $1,000. I've seen federal grants that they define a fixed asset as anything that's over $5,000. And some organizations have adopted that same policy because that funder happens to be their largest funder, and so it's easier for them to follow the policy of the funder for their entire agency rather than have a policy that differs, but then have to remember, oh yes, by the way, even though we may call this a property, plant, and equipment item because it meets our definition, it doesn't meet that of the federal, so we wouldn't keep it in that same category when we're providing reports to the federal agency. So you can see how that can get confusing, and to the extent that you're in a position to adopt maybe a funder's policy, it makes it simpler. And I do know that, well, I don't even want to bring that up. I was going to go into another subject, but I want to keep this as simple and as straightforward as possible. And if you ask the question, then we can get into it. The other component of defining whether something is property, plant, and equipment is that it has a useful life of over 12 months, meaning it's going to give you benefit beyond the current year. Otherwise, it's considered a consumable supply. So the perfect example is paper. You buy a box of paper, you use it up, it's gone. So even if you spent $1,000 on paper because your dollar threshold is $1,000, it's not going to last you more than 12 months. So you're just going to expense it immediately. So as you're looking at the financial statements, you're making a distinction between those things that the agency has that can give it benefit into the future versus something that they're going to use up immediately and should be on the statement of activities. And that becomes important because you need to ensure that you have things properly classified. And that's one of the things that auditors test for and look for. And it's an area where you could have manipulation. Because the biggest areas that organizations, nonprofits and for-profits, see fraud is in usually the accounts payable area and also in property, with how things are being defined, how they're being recorded, where they're being reflected, and then actual theft in the case of property and equipment. So you have to ensure there's policies around how do we protect the physical assets that we have as the organization. So, you know, circling this back around to the board's responsibility, you want to ensure that the board is setting policies for these kinds of things. And then the staff, typically the director, will roll out the specific procedures that need to be in place to ensure that these policies that the board has set are being followed. Depreciation. This is the other side of property and equipment, another area that can sometimes be confusing for board members, but it's just stating that because this asset, this property item, this computer has benefit to us in the future, we're not going to expense all of it at once. We'll put it on the balance sheet as an asset, we'll show it as something we own, and then we will put into the expense a fraction of that cost. Say you have a computer and the computer is going to be good for 3 years. Then you'll put the cost of the computer on the balance sheet and 1/3 of it will get expensed into the statement of activities each year. And that's just allowing the user of the statements to recognize the fact that this item is benefiting you for more than just this 1 year that you've purchased it. And so you want to apply that expense over each of those years and not just in the current year. Leasehold improvements, not a major concept. You can read that for yourself, but basically it's just the difference between owning the building and renting the building. If you rent it, if you make physical changes to that space, then you capitalize it. You record it as a fixed asset, as a property item, but you just call it something different, leasehold, for the most part, but primarily because you can't take that with you when you leave. You can take the table with you, but if you build something into the wall of the building that you occupy, you're not going to rip it out of the wall when you leave. Liabilities, we talked about that, whatever the organization owes, so not a lot of detail needs to be shared here. And then the net, what's left over at the end of the day. You have everything you own, which are the assets, everything you owe, which are the liabilities, and then what's left at the end of the day, which is the net assets. And this used to be called fund balance, primarily because of that whole fund accounting concept where I gave you that definition earlier, tracking everyone's source of funds by who provided it. And in the nonprofit world, there's three categories: unrestricted, temporarily restricted, and permanently restricted. And on the handout that I referenced earlier of key terminology, each of these terms is defined in detail. But it's critical to understand these categories because every organization is seeking unrestricted funds. You want to have the funds to do what you identify as the most necessary. But if an outsider provides you funding and they place a restriction on it, then that restriction is either temporary or it's permanent. And so only an outsider to your agency can restrict funds. And the reason I make that distinction is that internally the board might decide to set funds aside for a specific purpose, most notably reserves. Another best practice among nonprofit organizations that boards should consider is whether their agency has a reserve. And the reserve would represent an accumulation of funds over time that will be available to the agency in an emergency situation. If you suddenly lose a large source of your funding, if you have a catastrophic weather occurrence and it forces you to, shut down your operations, or your operations facility is destroyed and you have to move. When the real estate bust occurred and many nonprofits were closing their doors, others of them were able to keep their doors open because they had the reserves. It might not be anything as dramatic as any of those. It may just be that you have an intention to expand your operations at a specific time in the future, or your services, or information is showing you that you need to move your services into a new community, or you need to provide resources to your staff with updated technology. All those kinds of business decisions require cash, require funding. And so as part of your strategic plan, the board may have said, we will fund these future expansion decisions with our reserves. So we will, in our financial plan, set aside a certain amount of our surplus each year so that by 5, 10, or 15 years out, whatever the timing is, we have X amount of dollars set aside to accomplish that. Those are designated funds. That's because internally the board has made that decision and they can change their mind. With the restricted fund from the outside, you cannot do anything with those funds other than what that donor said you had to do with them. So if they've restricted the funds to a specific program, or they're going to provide the funds at a specific time in the future, such as with a pledge, by definition, it is restricted. Some audit terminology, cost concepts. This is one area. I won't spend too much time on it, but I'll just say that this just says that everything's recorded at cost. And for folks you're bringing onto your board that have a strong for-profit experience, that this, I'm sorry, that's not what I meant to say. For individuals who have not interacted in the business world as much or have not served on boards before, when they come into your organization, this is one concept that's sometimes hard to understand because they think of market value. They think of their house. They paid $100,000 for their house and now it's worth $120,000. In accounting, we don't write it up to the 120. We're showing it at the $100,000. And that's the cost concept. So when you look at an organization's financials, you're not necessarily seeing the full value of the organization because things are recorded at cost, unless you're talking about investments, and that's a whole nother conversation and valuation, which is beyond the scope of our basic conversation today. So that's really what that cost concept refers to. Going concern, usually not an issue. You won't see it unless it is, and that's why this term invisible is here. Basically, you assume that you're going to be open tomorrow. If there's something that indicates that you might be going out of business in the next year, then the auditors will point it out in their audit report. Otherwise, there's always the presumption that you're going to be here tomorrow. Materiality, this is a huge concept in that when you do have an audit, and we'll talk about this in the audit section, a lot of organizations assume that the auditors are looking at everything, and they're not. They're looking at what's material, and material just means that the dollar value of this transaction is so significant that if it's not corrected, it could change the way the reader of your financial statement makes their decision. And that's the perfect segue into the actual audit of the organization. So again, I only touched on a few definitions just to kind of hit the highlights of some of the more confusing areas, if you will, but also some of the more critical areas, and the full complement of terminology is in the handout. Now we're going to move into the actual audit report and then close with looking at the statements themselves. But I will check to see if there's any questions, and we still don't have any questions that have been presented. So with that, we'll just keep it rolling. Not quite sure if that's a good thing or a bad thing that there's no questions, but you know, again, we're just trying to give you a conversant knowledge and understanding of where the board should focus its attention and how it should use the information that it's receiving and what does it mean, so that for those of you that are on the call, you can take this back to your agencies and do your own training and help them to feel more comfortable about their responsibility as a board member. And then also even your staff, the folks that you have working in this area, can get a better understanding of the big picture and how it all fits together. So the audit, we talked about that. And that's the thing with my presentation. So hopefully you won't think, well, didn't we talk about this already? But instead you'll think, oh, okay, this makes sense now because she said it a third time. So I have things woven together in a way that some things later in the presentation we may have already talked about earlier in the presentation because it came up as part of an example I was giving or what have you. But it's all related together, and it just helps to further enforce the information. And if you hear it enough times, it eventually sinks in, or if it's said differently, then finally you grasp it. So we have talked a little bit about the purpose of an audit, and this just further itemizes that information. But again, as I said in slides before, it's for the benefit of outsiders to your organization so that they can gain some level of comfort and confidence in your information. Because as I often say in my presentations, donors don't give to organizations they don't trust. And one way you build that trust is by having an audit that says, we have a clean opinion, which doesn't necessarily mean everything's okay. It just means that you've complied with the requirements of the accounting rules. And as we move into more of these reports, we'll see some more about what I mean. It doesn't necessarily mean everything is okay. Types of opinions: unqualified, qualified, disclaimed, and adverse. The unqualified is the one you're seeking. This is the one that you hear referred to as a clean opinion most often. And the others really just represent the level of issue that the auditor has. If it's a qualified opinion, there's some element that was not in compliance. If there's a disclaimed opinion, is a larger exception to the situation. And if it's adverse, basically the auditor says we're not even going to render an opinion. Once you hire them, they can't come in there, look at it, and say, no, we changed our mind, we're walking away. So something has to be issued. And if the condition of your structure, your systems, and your records is so bad and it's not at all in compliance with generally accepted accounting principles, they're going to give you an adverse opinion. If there's some lesser degree of noncompliance, you'll be in one of those other two buckets. But the first one is what everyone is striving for. These are some common myths about audits, and again, I've alluded to some of these already. The audit is not necessarily going to uncover waste, fraud, and abuse, but it might. But that's not the reason they are there. I had one client that, really placed a lot of I'm not sure what the word is. It's escaping me at the moment, but they put a lot of value, I guess is the word, in the audit as it related back to their organization's operations. They assume that just because they received a clean opinion that everything was perfect. And it doesn't necessarily mean that. It just means that you've made all the correcting adjustments for the errors that they may have found, that you've recorded everything as it needs to be for the purpose of issuing that report. But as some of you may have encountered who do have audits currently, the auditors give you additional reports. Some are just for the benefit of the board, and they're addressed directly to the board. And they will tell the board, in the course of our audit, we didn't find anything, any fraud, any waste, any abuse, or what have you, but these are some areas that you might strengthen. These are some areas where you had some weakness. And a lot of times that's going to occur for your smaller organizations because you can't create a segregation of duties because there's just not enough of you. But what you do is you bring in maybe the treasurer to do some functions so that you can create that segregation, or you bring in an administrative assistant who's totally outside the accounting function to do certain steps, but they're going to give you their recommendations, and typically you're going to write a response to them that says how you're going to address them. But some of the myths surround the fact that, well, why didn't the auditor find that? Well, they weren't looking for it, but if they come across it, they will let you know. I already mentioned how they do not look at every transaction. It's on a test basis because it would be cost prohibitive for you to afford them if they looked at every single thing, and they would never leave almost, if you will, because they're looking at so much detail. So they have to use that concept of materiality that I defined earlier to identify what they're going to test, what they're going to look at. And from that, they can draw conclusions and make decisions about their comfort level with your processes and your numbers and your procedures. Unqualified means no irregularities have occurred. I already explained that. It doesn't necessarily mean that. It just means that everything has been corrected that needed to be, or if it was left uncorrected, it's because it was so minor in amount, or the impact of it being uncorrected is so minor that it's fine that it's not being corrected. Because some things you may just say it's $30 and we're talking about a $100,000 budget, we're not going to correct it. And then the last one is what I alluded to at the opening as well, with auditors routinely help with accounting for audit clients. No, they do not. They cannot, because that's going to impair their independence and their ability to render an opinion on your statements. Who should have an audit? We talked about this some as well. If you're trying to seek a specific source of funding, they may require that you have an audit. Best practices suggest that everyone be audited, again, because of the transparency, because of the confidence that it invokes, but the reality is not everyone can afford it. And so you either do not go after that source of funding, or you intentionally make a decision as an organization that you're going to put in a plan that will help you raise the funds that are necessary to allow you to have the audit that you need, because you recognize the greater value in having an audit. And of course, there's some, let me go back one slide. Of course, there's some grant sources that do require that you have an audit. Again, federal funds would be one of those categories. So we're moving into the last section, section 4, and this is where we'll get to look at an actual set of statements. So I've been speaking in theory, if you will, and giving you a lot of information about the statements, about the audit report, about best practices, about committees and terminology, and this is where we'll actually get to see what I've been saying, and then hopefully that'll crystallize things for you and push it over the top, if you will. Let me, as I've been doing, just check to see if there's any questions. Okay. Here's one. In previous years, I had encountered comments about federal accounting principles versus general accounting principles. Are these distinctions relative to what we do? Okay, that is the question. Well, federal accounting, they're still going to follow generally accepted accounting principles. So in order to have an audit and in order to receive that opinion letter, the financial statements have to follow generally accepted accounting principles. So if you have a federal agency that's requesting an audit, they understand that that audit is going to be performed in accordance with generally accepted accounting principles. But that agency may add to the requirements, and that's where you have the single audit, the A133. Some of you may be familiar with that. Some of you may have that audit. If you receive over $750,000 in federal funds, then you also have to have a OMB A133 audit. It used to be $500,000, and before that it was $300,000, but it recently was increased further to $750,000. And so when that audit is done, there's additional things that are being looked at. They're literally getting into more detail than the financial auditors would do. They're literally pulling file documentation in greater quantities than they would on a test basis for the financial audit. They're looking for compliance on a programmatic side and not just on a financial side. So in that respect, there could be other requirements. I have one client in particular that because of the source of its federal funding, they have to provide additional statements in their audit package. If you remember at the beginning of the presentation, I talked about certain other supplemental information that might be in that audit report. Because of that federal agency, there are in fact additional statements that have to be presented, and those statements have to be accounted for in the way that that federal agency has prescribed. So I think that's the question you're asking, and if not, please type again. But at the end of the day, there's the financial audit, which is what the independent CPA firm is hired to perform, and those records have to be in compliance with generally accepted accounting principles. On top of that, depending on whether you have a particular federal grant, there may be additional requirements that have to be presented in that report, and that report may require that you account for things in a certain way. And there should not be a contradiction, and there's usually an explanation of which one rules, if you will, but I think that's what you're asking by this question. If it's not, as I said, please type again and let me know, and I will attempt to respond. And I would also use as a further response Edgar as an example, because I know that there's certain property accounting rules that Edgar prescribes, but usually it's rules that say when you make a purchase, you have to get 3 bids, and you capitalize it and call it property, plant, and equipment at $5,000. And if our funds were used, then we have joint ownership in that asset should your agency close, so that if you sold the asset, we get the funding from it. So those kinds of prescriptions could be in the rule of that federal accounting manual, but typically it's not contrary to general accounting principles. It's just defining for you the minimum standard, and this is a perfect example of what I was trying to explain when I said you may end up adopting their thresholds as your own because it's easier to manage your books and records with one set of criteria, that being theirs, than to have your policy and theirs and have to keep going back and forth. Because I had a client that did that. They started with just $100 as their capitalization threshold. Well, they started buying a lot of things worth $100, so it was too many fixed assets to track. So they upped it to $500. Well, say there's still too many to track. Let's up it to $1,000. And then the Fed ended up saying, we as the federal agency, we don't want to see all these assets in these reports you're giving us. So we're setting a threshold for our own reporting at $5,000. And then the organization said, okay, if the federal government says 5,000 is their limit, let's just up ours to 5,000 as well. So I think that's what you mean by that. Let me look back to this question, if you'll bear with me for a moment. I think I've got further clarification. We are a very small jurisdiction. We have published requests for proposals for auditing services. Okay. Here's the question. We are in a very small jurisdiction. We have published requests for proposals for auditing services, but quite frankly, there is only one firm that can perform audits for nonprofit entities. Should we send out RFPs periodically to prevent the appearance of prior selection? Okay, so if I'm understanding the question, because of your jurisdiction, there's only one firm that qualifies to perform your audit, or there's only one firm that does nonprofit audits in your area. And so for that reason, you continue to choose that one firm, is the assumption I'm making. So then your question of should we send out RFPs periodically to prevent the appearance of prior selection, what I think you mean by that is, does it look like we've already made up our mind and we're always going to use that one firm, and that could be perceived negatively. And so because of that, should you send out RFPs periodically to make it look like you're doing your due diligence? I think that's the question being asked. So my answer is your policy should state that you have a process where you review the performance of your auditor on a periodic basis. And you define that in terms of every 3 years we'll revisit the performance of the auditor, or however many years you set. 3 or 5 is usually normal. And if in doing that you send out your RFPs and the only firm that replies is this one, and you're comfortable with their performance and their level of expertise in-house, then you've done your due diligence as an organization, as long as you're following the policy that your board established. So it doesn't necessarily mean that that's going to be the assumption others have. The reality is they still may have that assumption, but at least you have the documentation, the policy, the paper trail, and the procedures that you've executed to show that you've done your due diligence. What I will add on top of that is to say you might widen your scope. Depending on how large you are, it may be cost prohibitive for a firm that's further outside of your jurisdiction to audit you. So if you widen your scope, then you may be able to widen the number of firms that could bid so that it's not just this one, but they may decide it's not worth it to them to travel to your organization to do the audit. But in this day and age of technology, a lot of the audit may be able to be completed in their office. Even locally, audit firms do a lot of their work in their own office and ask you to send them documentation electronically. I have clients that have that situation. And so distance is not even an issue, but they've just become so sophisticated electronically that they can do a lot of the work back at the office, and then it only requires 1 or 2 trips to your physical site to manage everything else, so that it keeps their costs down and they're still able to make a profit, if you will, on taking you on as a client. So my response, to be clear, is that as long as you have a policy and a process and you're following it and you're making a reasonable determination that this is the best firm for you and they're adequately qualified, you should be fine. But if you want to broaden the pool, then you might send out RFPs to a broader distance and then let them determine if it's feasible for them and how they can make it work for their agency, because it is quite the practice now for organizations to be able to perform audits and not have to physically be at the client's location for a week or 2 or 3, but to only go out for a few days and then do the rest in their office. So hopefully that answers your question. And again, if it doesn't, please send me follow-up information and I'll take another stab at it. So thank you so much for those questions. So let's just, and again, I may have to ask Dave to jump in for a minute. I believe your microphone might be muted, but on this case study, if they don't have this handout in front of them, then this is not going to work.
I emailed actually the handouts to everyone that is attending, so it's in your inbox.
Great. Okay, thank you. Okay, so with this sample of documentation, the first thing I have, this packet has the sample auditor's opinion letter as the cover, and this is just for illustrative purposes here, red flag, yellow flag. You'll notice on the opinion letter down by the date, almost at the end of it, March 8th, you'll see a little flag and it has a Y on it. And so throughout these statements, the provider of this information has little flags that are yellow or red. In practice, the auditor might have some other means of communicating to your audit committee or your board things that they deem to be a red or yellow flag. And it's the traditional definition: yellow flag, warning; red flag, we've got trouble. So as a board member, as the auditor begins to point out these things when they go through the statement and present their findings, these are areas where you want to ask additional questions. And of course, the red flags are things that are really significant and critical and need to be addressed sooner rather than later. We talked about the unqualified opinion and what that means, and the going concern. If there was a going concern, usually that's around the 3rd or 4th paragraph where they would talk about it. But just in the presentation of this statement, they're pretty much the same. It's addressed to the board. It will have, at a minimum, 3 paragraphs. The first one talking about, these are the statements that we're presenting and this is the time frame that it covers. Second paragraph is going to lay out for you what was the responsibility of the auditor and what's the responsibility of the client. And it's going to explain what I explained, in that they're looking at things on a test basis. These statements are the responsibility of the client, and we're just rendering an opinion. They want to make it very clear who's responsible for what, because there was a time when so many things were happening and being discovered with an organization and its mismanagement, if you will, of funds, that people would start pointing fingers and say, well, why didn't the auditor discover it? And so this is one of those levels of protection by having that explanation. And then the last paragraph is the one you're looking for to see the opinion. So it reads, in our opinion, the financial statements referred to above present fairly, in all material respects, the financial position of the organization and the change in the net assets and cash flows. So that's the verbiage you're looking for, is that it presents fairly. and that's considered the clean opinion. In this example, they point out as a yellow flag the date of the report. If you look back at the first paragraph, the fiscal year end is December 31, and the report is signed and dated on March 8th. So the auditors always date their report on the last day of their field work. And so this is just a advisory that if your date of your report is more than 90 days from the end of your fiscal year, that could be a cautionary warning. It could suggest that your accounting department is not organized in a way that they can produce timely, accurate information. If it takes more than 3 months to be able to do an audit, the suggestion here is if it's over 120 days, then there's even more significant problem. Now, that's not to say there is a problem in the accounting department. It's just to say that as a board member, you might want to ask, why is this audit being completed so far after year end? Maybe it's a scheduling situation where you could not get on the calendar of the CPA firm and your agency to make it work until later in the year. But if you have hard reporting deadlines to other organizations, in particular federal reporting agencies, they usually have defined when they need the audit report by. And so that's usually a great outside boundary of how far out you can go before you get your audit done. So just one observation of something to look at. The footnotes, they begin a few pages back. In this document, they start on page 19, and this is just where you can get a lot of good, detailed information about an organization. If you're new, and we're not going to go through each note, so let me give you that heads up at the outset so that you're not worried and concerned. But if you're new to a board, one of the best things for you to do is to ask for their audit report so that you can look at the footnotes and begin to get an understanding of the types of transactions that organization has, how it keeps its books and records, how it accounts for its transactions, the fact that it's tax exempt, and it gives you an opportunity to look at related party transactions or the banks where they have their cash housed. So let me go through a couple of slides and you'll see what I'm referring to. The first footnote, again, just summarizes key accounting policies and their practices and their procedures. So a lot of the specific accounts I was going through with you in the terms section, you'll see them explained in more detail here in this section. Investments, it tells you how they account for the investments. This one's very simple and straightforward, but there's been changes in the accounting rules over the past few years that have expanded the requirements for investment. So again, I was trying to keep it very simple. So this is an older version that has a simple footnote. But as your investments get more complex, as you perhaps get donations and you create endowment funds, then this footnote will be much, much larger. Line of credit, again, I made reference to that in terms of cash flow issues. So in footnote 9, which is going to appear on page 24, they talk about line of credit. And here they have a yellow flag. Things that you want to be aware of as you look at that is, what's the interest rate the agency is paying. And again, this should not be a surprise to you as a board member because you've put in policies that define these elements. So when your director goes out there seeking funding in this area, hopefully they're following a policy that's already been established that will define, what the organization is willing to assume in terms of securing this line. Additional footnotes that aren't in this particular example, but that are very helpful when you look at an audit report, and also when you look at a tax return, questions are on there about this, related party transactions. You're allowed to have related party transactions in terms of the agency doing business with someone else that has a personal interest, that has something personal to gain, but as long as those transactions are arm's length, they're not out of the ordinary, they're not extraordinarily beneficial to the other party, and that you're disclosing the nature of the transaction, then it's fine. But as a practice, nonprofits do not tend to do a lot of related party transactions. For example, you might have someone on the board that has a company and the agency purchases services or products from that company. There's nothing that says you cannot do that. It's just from a perception standpoint, most organizations try to avoid it. But if they do it, they make sure that everything is arm's length and there's no unfair advantage to either party that someone else wouldn't enjoy if they were in that same transaction. And then any pending adjustments in the hospital environment, just for your information, because they get so many reimbursements from insurance companies and the billing codes and things are so intricate, what you report in the statement as what you think is collectible could very well change after there's a subsequent audit by the insurance company or something, or the negotiations change. So certain things that are reflected in here are based on estimates, and because they're estimates, they could play out differently. And so things that are significant you would put in your footnotes, and that's a way for you again to get further detail on situations that are not solidified, or situations that are questionable, or situations that are unusual, or situations that are extraordinary. So I guess my point here is the footnotes add a lot of information and value. Extraordinary transactions, things that don't happen ordinarily or normally, would be footnoted as well. So I think the last section of this particular part, the last part of this section, is about numbers, looking at numbers. And I guess you thought you were going to get away from not looking at numbers, but how can we talk about finances and not look at numbers? So this is a very, very simplistic presentation of a ratio that you might calculate at the board level. And again, remember that the financial information is both for internal purposes and for external users. And as a board member, you want to run some numbers. Your finance committee is probably running the numbers and then presenting summarized information back to the board. But this test is just to show you how much your assets can cover the liabilities of your organization. So if you take your current assets, which on your balance sheet, which is page 14, is maybe a third down the page, $2,299,482, and you divide that by your total, your current liabilities, which is the $441,934, which is on page 15 at the top, then you get that ratio of 5.2. And it's basically saying that for every dollar in debt that your organization has, in liabilities and things that you owe, you have $5.20 available to cover it. Or stated differently, you can cover your debt 5 times over. So that's what you want to have. The higher that number, the better. So very quickly you can look at it and determine if you've got enough assets to cover your current debt. Debt to net assets, similar calculation, but looking at it the opposite way, where you take your long-term debt, which is on the page 15, the $20,000, $191, and you divide it by your net assets, what's left over, the $2,333,000. And in this case, you get 0.009. And so this is telling you that your net is not substantially because of debt that you've taken on. In other words, you have $2,795,000 in assets. That's what's on page 14. You have $462,000 in debt. When you subtract that debt from the assets, you're left with the $2,333,000. But what this calculation is trying to tell you is that yes, we have $2,333,000, but of that, how much of that is really because we borrowed money? And in this case, so little of what you have left comes from borrowed money, you're in a great position. If the only reason you have $2.3 million available, or $2.3 million of assets available, is because you took on a lot of debt, say you borrowed $2 million, then that's not a good situation. You don't have a lot of cash that was generated from your grants and your services and donations, but instead you have cash that's been created as a result of debt, which you ultimately are going to have to pay back. So this is what they call a banker's ratio. Again, as you provide these to the outside, they're running a lot more sophisticated ratios. And again, I'm trying to keep this really simple for the board because, again, I know, they say if the person's number one fear is public speaking, I would say the next one is having to deal with numbers and math if that's not your forte or your choice. So I want to keep it simple. But what I'm seeing with foundations, particularly here in Atlanta, is they're asking for a lot of numbers off of your financial statements or your tax returns so they can crank out these ratios and draw conclusions about your stewardship and your ability to manage your funds and to pay your debt and to cover the cost of your programs, to make decisions on whether they should award you the grant that you're writing the application for, that you've submitted the application for. So it's good for you to have an understanding of these ratios for yourself internally as a board, because outside funders, in particular foundations, not so much your federal organizations and state and local governments, but your foundations are looking at this a lot. And then from a profitability standpoint, yes, we can have a profit in a nonprofit, and you must have a profit in a nonprofit, and this is how you end up building the reserves that we talked about earlier in the presentation. And you want to be able to use that to, as I said, expand your programs, refine your programs, expand the communities that you serve, expand your staff, because your caseload, your clients that you're serving is increasing and you need more staff to expand the resources that you work with, the technology, the hardware and such. And even your facilities, you might need more space. So this profitability calculation is just to see for every dollar you bring in revenue, how much is left over. So you can read through how to do the math here, but at the end of the day, it's saying for every dollar that you bring in revenue, there's only 7 cents left. So this is a yellow flag. If I remember correctly, because I don't work in the for-profit arena, I don't serve for-profit clients, they like to try to get 30%, a 30% profit at the end, or 25%, or something in that market. And so if you look at that here and say, okay, we're bringing in 7 cents, then that's not necessarily going to sustain us. And a lot of organizations in the nonprofit community functioned under the assumption that we just need to break even. We want a balanced budget. We want a zero budget. We want revenues to always equal expense. And I think I've said it enough during this presentation that that's not the case. You want to generate a surplus. You just don't want it to be excessive. And that's the one thing from the outside looking in that donors have an issue with, is all of these funds that are just sitting there at nonprofit agencies and not being put to use. So you want to be cognizant of not building up too much surplus, or if you have the surplus, that you at least designate it internally as a board that they're for these specific projects and functions that will be rolling out in the near future for the organization. The next analysis is the spending ratio, and this is really where the question comes into play on where is the money going, how much is going into programs versus how much is going into management in general and fundraising. And you can calculate this both from the statement of activities, which is on page 16, because in the expense section you see those 3 categories. Program services total $4,182,000. And then supporting services is broken down into 2 categories of general and administration and fundraising. And so you can take those numbers from this page, or you can take them from page 17, which is that same information, but now it's broken down not just by those categories, but also by what we call natural classification. So you can see specifically that Program A spent $459,000 on salaries and benefits versus Program B, which only spent $318,000. So either of those reports will give you the numbers you need to do the calculations on this page. And again, I'll let you read through that on your own, but the bottom line, what I'll report to you as the result, is in the program spending ratio, 82% is the number they came up with when they took their program expenses as a percent of total agency expenses. And that's excellent. That's saying that for every dollar that your organization spends, 82 cents is going directly into programming. And when you look at management in general, right below it, for every dollar that the organization spends, 10 cents is going into management in general, accounting, HR, and all of those other kinds of administrative overhead type costs. And then on this slide, when we do the same calculation, taking fundraising expense as a percent of total agency, only 8% is going into fundraising. So those are good percentages. So this page just summarizes those stats that we calculated on the prior slides. And this might be something you put on a report to the board. Maybe the finance committee is crunching all of these numbers, but as a board, you're just asking for the summarized level of what the numbers calculated to be. And then you're asking to see that in comparison to the prior month, the prior quarter, or the prior year, because all information should be compared against something so that you can see the trend that's developing, and you can measure yourself against certain benchmarks that you might have established as a board as to what you want those numbers to be, and that way you can strive for that goal as part of your financial plan. Let me see this slide. Comments, overall analysis. This is an overall analysis of this particular example, so I'll leave that. And then this slide is, all of this leads us to, what do you do from here? You do more analysis. You ask more questions. You might dive into a more detailed financial analysis performed by your chief financial person, whomever that might be, whatever their title might be, in concert with your director of the agency or with the treasurer or the finance committee of the board. And so what you have with you are two additional handouts, one of which, questions to ask. It's titled Questions New Board Members Should Ask. And I put new board members because when you come onto a board new, it's assumed that you don't know anything about the agency other than what was shared with you to try to encourage you to join the board. So it's logical that you would ask these questions. But as a current board member who's been on there for some time, this is a way for you to focus your attention on what might be critical, what might be some gaps in how we're managing the finances of this organization. And so these questions are just a short list. Again, there's so much more information that you could try to address, but I'm trying to give you just a small, compacted resource that you can start with. And from here, you can expand and drill down even more specifically. The last handout that you have, the financial risk assessment, this I've taken from the website, which you have access to as well, of an organization called the Nonprofit Assistance Fund. And this is a great resource. This really helps the board to measure the risks that it might be facing. And the lower the number of points you score, the better. And so you can see in the first section, financial health, that the 3-point columns are 1, 2, and 3 points. And when you get to the end of number 7, you'll see that if you have 9 or less points, then you are at low risk, and 10 to 12 moderate, and 13 or more high. So definitely the fewer points you have, the better. But it asks questions such as, the number of the most recent 3 fiscal years that ended with a surplus. So here we just finished talking about wanting to have a profit, wanting to have a surplus. If your last 3 years running each showed a surplus, then that's great. You get 1 point. But if 0 to 1 years showed a surplus, then as a board you might say, okay, we need to be intentional and try to map out a plan that's going to generate a small surplus so that we can then do these other things that we've talked about doing. Next question, percentage of contributed income included in the budget that is committed or highly reliable. A budget is just that. It's a budget. It's an estimate. And to the extent that you can count on what you've put in your budget and already know that it's going to occur, that you have a pretty solid feeling that it's in the bag, so to speak, then you are doing better than those numbers in your budget that are really just an estimate because it's the best number you could think of. So again, I'm not going to go through all these pages. It's very all these questions on these 2 pages. It's very straightforward, but I believe this is one of the best tools I've come across and that I'm very excited to be able to share with organizations that I've been training since I found it. To help them focus their conversation around the board table and not get bogged down in the traditional financial statements, because although they're key and they're critical and we've just spent all this time talking about it, they've got to lead to a bigger conversation around the board table that focuses on your stewardship and growing your reserves and ensuring that you've got solid funding streams to ensure the sustainability of your organization. Yeah, let me go back. So that brings us to the end, and I'm going back to the list of questions. I don't see any new questions posted. Okay, I'm receiving confirmation that there are none, and I'm also showing 6 minutes left. We were able to address the questions as we went through the presentation. I would have liked to have allotted a little more time at the end for additional questions, but I feel like we've addressed those concerns that you've had. So I will open it up one last time to see if anyone has any final questions, comments, or observations that I can address for you before I turn it back over to David to close us out. Okay, I'm not seeing anything. As David is talking, I will keep monitoring it in case someone was still typing and didn't finish it. But I thank you for your time. I hope this was helpful. I hope it was not too dry and boring. And I really hope it gave you a sense of confidence now and a sense of comfort with what you perhaps already knew and gave you a little bit of direction on how to better execute your responsibility as either a board member or the executive director, leading and working in tandem with the board, as well as leading your staff. Or thirdly, if you're a staff person who's new to perhaps nonprofit accounting and needed that education and training. So with that, I will say thank you for your time and attention and turn it back over to David.
Thank you, Glenda, and we're very appreciative of the information that you gave tonight. The webinar will be archived. We'll email out the link to that archive so that if you weren't able to attend all of it, or if you have staff or board colleagues that you feel would benefit from it, certainly let them know that they can take advantage of that. And with any of these activities, we appreciate that when you get the survey through SurveyMonkey, if you would take a few minutes of your time to complete that for us, it would help us greatly. And we promise to keep those questions really brief so that it values your time. In the email that announced this webinar, there was a second webinar that we would ask you to hold the date for, save the date, October 28th, 1:30 Eastern to 3:30 Eastern. Bill Kreisner is going to be focused on the salary threshold changes to exemption and non-exemption under the Fair Labor Standard Act, including other issues such as managing difficult issues around employee leave and conducting internal investigations to avoid liability. So we hope that you save that date and look for the registration link next week. So We again appreciate your time. This concludes the webinar. Thank you.